Very good afternoon to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountants of India, I welcome you all in today's very important webinar on the topic Fair Value Consideration during Audit. This would be our 71st CP program organized by AASP of ICI this year. And we are having with us our past Central Council member, MP Vijay Kumar ji. I welcome on behalf of AASP of ICI, sir. Welcome, sir. We are having with us our today's learned guest speaker, C. Parag Gandhi ji. I welcome you, sir, on behalf of AASP of ICI. So, due to the one emergent meeting, our chairman, sir, and vice chairman, sir, are not able to connect. So, if you permit, sir, can we start, sir? Sir. So, it is my proud privilege to share with all of you the brief profile of our past Central Council member, CMP Vijay Kumar ji. CMP Vijay Kumar ji is engaged with the passion and pragmatic and visionary and a provisional executor. He is having more than 30 years of experience in industry as an accountant in practice. He was associated with the institute as a council member in the 2019 till 2022. He was the chairman of Accounting Standard Board, 2018 to 19, Valuation Standard Board, and 2017 to 18, the chairman of Digital Accounting and Assurance Standard Board of ICI. As a vice chairman, he has served the from 2019 to 20 Expert Advisory Committee of Institute, and 2018 to 19 the Financial Review Reporting Board (FRRB), and 2017 to 18 Committee for Accounting Standard Board of Local Body. He was a nominee of the National Financial Reporting Authority (NAFRA) for 2019 till 2022, and nominee of the Quality Review Board 2016 to 19, and nominee for the SEBI Committee of the Disclosure and Accounting Standards for 2016 to 19. Presently, he is the Chief Financial Officer of CP, and before that, he was a partner in Yoganand and Ram LLP, and before that, he was part as a head of the investment banking with Sundaram Finance Limited. And he is having India, Joji Finance Services, Heritage Food Limited, Thuro Engineering Limited, Sela India Software Services, and CP Singapore Limited. And he was a former director of National Internet Exchange of India and XBRL India Limited. And he has. We can start. Yes, sir. Still, the list is very vast, sir. It is my proud privilege and it is my fortune to just have a look at your profile, sir. So thank you so much for sparing your valuable time and acceding to our request on a very short notice for your keynote address, sir. Yeah. So on behalf of WSU or ICI, I once again welcome you, sir, and request for your keynote address for today's webinar.
Thanks, Anil, for the kind words of introduction and also for coordinating the invite. Greetings to all the members and to today's speaker, Parag, who was kind enough to accept the Institute's invite and share his knowledge on a very important topic with all of us. Trust all of you are safe and your near and dear ones in good health. Sincere thanks to the WASB leadership for this invite. Very interesting topic for today's deliberation, and I'm confident Parag will give a very good insight of Essay 540 with focus on fair value considerations. Each of us are aware that the end product of audit is expressing an opinion as to whether financial statements are prepared as per the applicable financial reporting framework. We presently have 3 financial reporting frameworks, 2 of them under Companies Act, Ind AS and AS, and 1 issued by ICAI for non-companies, which is the AS framework. Fortunately, the AS framework for companies notified under the Companies Act and AS framework issued by Institute for non-companies are the same. While many tend to identify fair value with Ind AS, my experience is that fair value requirements are fairly significant even in AS framework. For example, AS 13, you have lower of cost when it comes to current investments, lower of cost and fair value. market price is an evidence or an indication of fair value, but the policy per se is fair value. Similarly, if you look at AS 15, when we do the actual valuation, we have the concept of fair value of plan assets. AS 19, leases, finance, lease, lessee books. If fair value is less than present value of MLPs, then you record at fair value. Similarly, AS 28 on impairment of asset, you have net selling price, just more or less the same as fair value, or when you arrive at value in use. And when it comes to share-based payments, also you have the need for determination of fair value. In Ind AS, the fair value usage is relatively more, given that it's a framework which is meant largely for public interest entities. And it is important that the user should have a timely understanding of fair value of several items in financial statement as at the date of the measurement as applicable. For example, investment property Ind AS 40. While currently we have at cost, we still have a requirement of presenting fair value. The reason is investment property by its very characteristic is an asset held for capital appreciation, and market values keep fluctuating. So it is important that the users of financial statement, if they have invested in an entity which has investment properties, they should have an idea of what is the fair value of such assets, and volatility is given. That volatility needs to be captured in the financial statements. One should not hide volatility outside. So if the environment is volatile and it is impacting your assets which you're carrying in books or the liabilities you have, it's important that the same should be captured inside the financial statements. At times it gets recognized, at times it is disclosure. That's a different discussion. But the point is, the user of financial statement should have fair value or should have information of fair value, recognized, unrecognized. For the purpose of audit, SA 540 very nicely recognizes that fair value is an accounting estimate, and it refers to the same as fair value accounting estimate. So if you look at the literature, and I'm sure Parag will take you through, when you look at accounting estimates, there are accounting estimates, vanilla type, and fair value accounting estimate. That's another class where you have additional guidance. And for these fair value accounting estimates, there is quite a good amount of specific guidance given in the standard. And importantly, the appendix to SA 540 also lists down very nicely, the various issues which are relevant to fair value accounting. Whether it is just fair value or fair value less cost to sell, observable inputs, non-observable inputs, valuations which are determined based on market price, so on and so forth. All of those are so neatly captured in that appendix. I don't recall readily, but it's 2 or 3 pages if my memory serves me right. And it's so nicely captured. My 2 cents on this topic before I hand over to Parag. One is fair value estimation is a specialized work. While managements do it, auditors have equal responsibility to validate all the assumptions which have gone into determination of fair value. I'll give an example, a little distant, but for simplicity's sake, since all of you can connect. I don't want to say it's a right example around fair value, but it's easier to understand as to auditor's responsibility of validating all the assumptions. take a standard like AS 15 employee benefits or Ind AS 19 actuarial valuation. More often than not, my experience is many tend to accept the actuarial valuation at face value and just take that number and plug it into financial statement. And the actuarial valuation report is treated as gospel, just accept it as it is. That does not relieve the auditor from responsibilities. The actual valuation is made up of several inputs and assumptions. Inputs can be regarding number of employees, the salary levels. Those numbers have to be verified by the auditor. One cannot assume that company has given the right data and the actuary has considered the right data. Similarly, there are assumptions regarding salary growth rate, discount rate, demographics, mortality, so many other things. All these assumptions also, the auditor has to satisfy himself or herself that those assumptions are relevant assumptions. For example, when you take a discount rate, if somebody were to take 100 basis points higher, then you would end up with a lower liability. So as an auditor, I need to put my hands up and say, look, this is not the discount rate which is applicable. So that responsibility lies with the auditor. The same is true with SA 540, when wherever we have fair valuation. You cannot rely on the external report and just say that this is correct. And in the audit standards itself, we also have responsibility on the auditor to satisfy himself or herself that the expert, the subject matter expert, who's giving the valuation report, valuation number, is competent. So if I am relying upon a fair valuation figure given by a person who has never done valuation of, let us say, an oil and gas industry, I should not accept it. It's important that I should be convinced about the competencies. That responsibility is also with the auditor. That's point number one. The second point which I'd like to mention, whenever in doubt, it's just critical for an auditor or audit firm to know every fair value determination. Whenever in doubt, do not hesitate to engage a subject matter expert to assist as a team member for audit of those 1, 2, 3 items where there are fair value requirements. Let's say fair value less cost to sale, whether it is agriculture, whether it is livestock, whether it is impairment, whatever it is. So if the team members don't have that capability, do not hesitate to outsource and include as part of your team members, because the responsibility eventually lies with the auditor. And the fair valuation process is also becoming fairly automated. And the role of management and even auditors is all about whether the right set of inputs have gone in and the processing has been done properly. Last observation, most valuations will always be subject to test in future, where the regulators will always have the benefit of hindsight. Every situation of fair value, given the kind of potential impact it has on financial statement and the associated volatility, there will always be plenty of hindsight information for people to question. So it is very important that within the audit firm, you should have a work environment where the valuation assumptions are challenged and debated. And that's very, very important. You should not accept it. There should be a good amount of debate within the team, whatever management is considered, whether we are acceptable with the same. Lastly, on an independent note, from a future perspective, I'd like to share my thoughts on the future of financial reporting. The users of financial statements have a very clear expectation that historical information is no longer relevant. Nobody is interested in what was the position as at 31/3/22. That's history. Everybody expectation is around predictive value. So take our own personal life. For you and me as an individual, we are not interested in distance between place A and place B. Our interest is, if we were to travel today evening at 5 p.m., will it take 40 minutes? Will it take 60 minutes? So what we are interested is in that predictive information. When that is so true for us individuals as consumer of a product, any product or service, the same is true for the users of financial statement also. For our profession to stay relevant, it is important to ensure that our output, whether it is in financial statements or audit opinion, have that predictive value. I know it is tough. I know it's very tough, but the hard truth is it is inevitable. We have to develop ways over time to reach that goal. I'll conclude quoting the founder president of the institute, late Shri G.P. Kapadia, whom I literally adore. Quote, the profession's resilience and practice to respond to the changing situation and growing demands on it will determine its continued existence and growth. Unquote. Thank you for patient listening. Wish you a great learning session from Parag and a very happy learning. Stay safe, stay accountable.
Thank you so much, sir. Thank you so much once again for your words of wisdom and experiences shared by you relating to the financial reporting. On behalf of WSP of ICI, once again, I extend my heartiest thanks to you, sir. Thank you so much, sir. Thank you. Sir, if you kindly permit, can we start the technical session, sir? Thank you, sir. We are having with us our guest speaker, CA Parag Gandhi ji, to tackle today's session. Parag Gandhi ji is a chartered accountant with more than 12 years of experience in assurance practice of SRB and Company LLP. He is currently working as a director. Has worked on a statutory audit of listed companies, public and private companies from manufacturing sector and infrastructure sector. And relating to the startup investment trust under IND-AS, these are special purpose audits and group reporting as per IFRS, Singapore FRS, and US GAAP. He has also worked on capital market transactions such as IPOs, QIPs, right issue, etc. So without wasting much more time, now I request Parag Gandhi ji to please deliberate on the topic. Over to Parag ji, please.
Thank you. Thanks for the introduction, and thank you, MP Vijay Kumar sir, for your keynote address. It is really important, and it set the context of this session. Thanks a lot for that.
Fine, sir.
Yes. First of all, I like to thank all the participants for today's session. Considering occasion of Raksha Bandhan, it is really appreciable that everyone is attending the session. This session is regarding the fair value consideration during the audit. It basically considers the requirements of SA 540, and in SA 540, the specific considerations which are related to fair value assumptions. This session is divided into various topics. First one is related to understanding the fair value concept with respect to financial reporting framework. What are the challenges related to auditing the fair value assumptions? The requirements and guidance under various auditing standards which is relevant for the work of an auditor. And what are the audit considerations specifically related to audit documentation which auditor should pay attention to? At the end of the session, I would like to answer the questions. So I will start with the understanding of fair value concept. The fair value concept is not defined under the auditing standard, and it is dependent on the financial reporting framework. In India, currently, we are following two types of financial reporting framework for listed entities and entities having net worth above specified threshold. Ind AS framework is applicable. And for other entities, Indian GAAP framework is applicable. As explained by MP Vijay Kumar sir during his keynote address, under both the financial reporting framework, there are fair value considerations which are important for the auditor's work. In Ind AS, the fair value consideration is slightly higher than the Indian GAAP. And in Ind AS, we have Ind AS 113, which specifically defines what is the fair value in context of Ind AS. While dealing with fair valuation, Ind AS 113 specifies that fair value for an asset is a price that would be received to settle the asset, and for liability, price that would be paid to transfer the liability. In an orderly transaction between market participants, these two things are very important. It emphasizes on orderly transaction between market participants and not only from the perspective of the entity. Why it is important to understand is when we are performing audit procedure around the assumptions used in the fair valuation, it is important we know the financial reporting framework and what is the meaning of fair value in that financial reporting framework. Under Ind AS, as fair value definition emphasizes on orderly transaction and expectation or orderly transaction between the market participants, the development of assumption on the basis of expectations of market participant is very important. The orderly transaction between the market participant should be at measurement date when balance sheet is prepared as at a particular date. The fair value should be considered at a measurement date, that is the reporting date. Fair value measurement and disclosure is primary responsibility of the management. While preparing the financial statement, management needs to establish an accounting and financial reporting process to determine the fair value measurements and disclosure, select appropriate valuation methods, identify and adequately support any significant assumption used, prepare a fair valuation, and ensure that presentation and disclosure of the fair value measurement are appropriate. Though it is responsibility of management, auditors are equally responsible to assess the process set by the management, assumptions used by the management, because ultimately auditor is responsible to issue an opinion on the true and fairness of the financial statement, which includes various captions of balance sheet, profit and loss account, and if fair valuation is related to a specific caption, ultimately it is auditor's responsibility to ensure that the amount which are recorded in that caption are giving true and fair view of that account balance. So when we discuss about fair values, okay, there are certain items of assets and liabilities where fair value is readily available because those items are generally bought and sold in the active market. For example, mutual funds. As at particular date, you get the NAV of mutual fund. So to record a transaction, management can use that NAV, and as an auditor, we can verify the supporting document, external information available on various sites to check the NAV and get a comfort over the fair valuation of mutual fund. Similar approach can be followed for equity instruments where quoted market price are available. certain derivative contracts like foreign exchange forward contracts, which are plain vanilla contract, M2M in case of a future commodity contract where commodity prices are available on, let's say, London Metal Exchange. In such cases, for auditor, it is relatively easy to verify the fair values used by the management in preparation of the financial statement. But there are certain financial items like assets and liabilities. Those fair market values are not readily available, and those are required to be developed on the basis of certain valuation techniques by using certain assumptions. And auditing these type of fair values is very critical for any auditor, because those fair values are based on valuation techniques and certain set of assumptions for which market data may not be readily available. When we discuss about use of valuation technique, a generally used valuation technique is a discounted cash flow model. So in case of valuation of multiple businesses, valuation of certain PP&E, valuation of goodwill, discounted cash flow technique is used, which involves discounting the future cash flows at a discount rate and arriving at the current value of that instrument or a particular asset. When we discuss about the fair valuation, there are certain examples under Ind AS where fair valuations are critical. Okay, let's say there is a startup and that startup has issued a convertible instrument, optionally convertible preference shares. Okay. And the company has assessed that this instrument is fair value through profit and loss account as per the requirement of relevant Ind AS. At each reporting date, the entity, the management of an entity will carry out the fair valuation of this instrument. And there could be a significant impact of this fair valuation on the financial statement, because initially a startup is heavily dependent on the funding from the investor. And as the value of the business changes, the value of this instrument also changes. So the fair valuation charge in the statement of profit and loss account due to increase in fair value could be significant. And in case if there is any error or any judgmental issue in determining the fair value, then it could impact the true and fair view of entire financial statement. In case of share-based payments also, let's take an example where a company is issuing a share appreciation right to its employees, and the payment against the share appreciation right is dependent on the fair market value of shares. So on the grant date, let's say fair market value is 100 rupees, and there is a condition that if value increases to 200 crore or 200 rupees in subsequent years, then the difference between the fair market value will be paid to employees in the form of cash bonus. Okay, this is a cash settled share-based payment scheme. Now, as an auditor, can we just rely on the valuation report provided by the management and record the liability in the books of accounts? No. As an auditor, we are required to test the fair value and get comfort over the assumptions used by the fair value and conclude that the fair value is reasonable, because these share-based payments are charged to profit and loss account. Ultimately, there is a cash flow which is going to the employees. So the management who is preparing the fair valuation may be interested in arriving at a fair value which is beneficial for them. So as an auditor, it's our responsibility to understand the background of the transaction, what factors are important, and then test the fair value. Fair values are also nowadays important in impairment assessment, whether it is a infrastructure company, whether it is a normal manufacturing company which is facing some challenges due to current economical condition. Then the impairment of property, plant and equipment is also important. And to arrive at value in use of a property, plant and equipment, a valuation model will be used, which is based on a discounted cash flow model. Also, as discussed in keynote address, for investment property or properties which are held for sale. Okay. In case of investment property, it is important to disclose the fair value changes in the investment property. Though investment property is recorded at cost, the fair value movement is required to be disclosed as per the Ind AS, so that the users of the financial statement get fair idea of the market value of the investment property. In case of properties held for sale, okay, basically non-current assets held for sale, it is important to value them at fair market value or cost, whichever is lower. So in this case also, auditor needs to understand how fair value of a particular item is determined, so that he will be in a position to comment in his audit report. Okay. In case of business combination also, for valuation of goodwill and intangible asset, understanding the fair value is very important. So if you see nowadays, the transaction which involve fair valuations are increasing, and in future they are going to increase a lot. So as an auditor, we cannot just rely on the report provided by the management or management expert and consider it for the forming our opinion on the financial statement. There are certain additional responsibilities as per SA which we need to adhere to, because we state in our audit report that audit report is issued after considering the relevant standards on auditing. Also, nowadays, with the introduction of Ind AS and the complication of various transactions, regulators are also giving more importance to the procedure performed by the auditors, responsibility of the auditor under specific auditing standard, and whether auditor is able to demonstrate that the auditor has complied with the requirements of the auditing standard before issuing the audit report. If you see recent reports of NAFRA, there are many comments related to the judgments used by the management and evaluation by the auditor. Okay, whether it's related to impairment, fair valuation, goodwill impairment, etc. So in case of understanding the fair value, there are certain examples which I would like to discuss, and these examples we will continue in further discussions as well. So one discussion which we had was related to a startup entity which has issued optionally convertible redeemable preference shares to the investors. These optionally convertible preference shares are assessed as a financial liability, and the company has adopted a policy to fair value through statement of profit and loss account as required by Ind AS 109. Okay. The OCRPS by nature will have specific characteristic, because when an investor is investing into any business a significant amount of money, they will have certain additional right. Okay, so these instruments are developed in such a way that the investor has certain right, like a buyback option, exit options under various scenarios, as well as liquidity preference. At each reporting date, management has adopted a policy of fair value through profit and loss account, and at each reporting date, management will carry out a fair valuation of this instrument, and as an auditor, we need to verify this fair valuation report along with the normal accounting entries or the accounting for the transaction. So there is certain additional procedure other than the accounting, not only relying on the report of the valuation, which is required from the auditor. Okay. In next two examples also, we are going to discuss about the employee share-based stock appreciation right, where a company has issued stock appreciation right for which payments will be made over a period of 3 years. Now, these stock appreciation rights are different from employee stock options. For employee stock options, there will be fair valuation at grant date. The fair value will be fixed and the charge will be taken over a period of service of the employee. Now, in case of employee stock appreciation right, the fair value changes at every reporting date, and ultimate payment will happen after a specified date, and the difference between the fair value will be paid to the employee. So as an auditor, during each audit, now auditor needs to see the fair value to ensure that the provision or the accrual related to stock appreciation right is appropriate. In case of infrastructure sector, there are many companies which are having multiple subsidiaries for various projects. Now these companies elect an option to fair value their investment through other comprehensive income. So this is an option available under Ind AS, and many companies are electing this irrevocable option. Irrevocable option, once opted, they cannot go back to cost approach or any other approach. So once they select fair valuation on approach, as an auditor, every reporting date, auditor needs to assess the fair valuation. So the responsibility of the auditor to assess the fair value considerably increases if such type of transactions are there in the entity. And considering current economic scenario, current business transaction, there are many entities which are entering into such transactions. So the frequency of such transaction has increased significantly over a period of time. So when we discuss about fair valuation concept, the financial reporting framework related to fair valuation, okay, what can be different types of transaction where fair value considerations are important. Now let's discuss about certain challenges related to auditing fair valuation. Okay, not just accepting report is important, but when you get a report of a fair valuation, or when management provides a working related to fair valuation, what challenges as an auditor we face and how these challenges are required to be addressed is equally important. There are guidances available under various essays which we will discuss. The basic premise of this discussion is by different professional in different manner. So you will have different views on a particular assumption. So the subjectivity of fair valuation increases a lot. For example, let's say cost of equity is used in a discounted cash flow model while arriving at the weighted average cost of capital. Weighted average cost of capital is computed on the basis of cost of equity and cost of debt by applying them weights on the basis of proportion. So cost of equity for a particular business based on the industry, based on the nature of business, could be 15% for a particular professional. It could be 18% for particular professional based on their risk appetite, their views about the business. So fair valuations are subjective. Second, the valuations are typically developed by management or the third party professional. They also apply significant judgment, other qualitative inputs while developing this fair value measurement. So suppose they are valuing a business and there are certain risks associated with the business. These risks or the factors will be considered as qualitative inputs. Let's say they are constructing a project in a geographical area where they will face certain challenges related to construction of that project. Now, the risk associated with construction and completion of the project is factored in the valuation in the form of a risk premium. Similarly, suppose there is an entity which is operating in a particular geographical area where economic environment is very uncertain. Then the operating effectiveness of that entity is dependent on the economical environment, and the risk associated with operations are factored in the cost of equity. Okay, so these qualitative inputs are also considered by the management, and as an auditor, we need to be aware of that. Then only we will be able to effectively evaluate them. Okay. When it comes to developing a fair value measurement, there are a number of variables and potential assumption involved. In a simple discounted cash flow model, where we are projecting or the management is projecting future revenues, future cash flow, there could be multiple assumptions. What will be the revenue growth rate year on year? What will be the proportion of various expenses to revenue? What will be the cash generation from the business? What will be the finance cost, rate of finance cost? What will be the tax impact? Frequency of cash flows. So these are the potential assumptions which are used in developing a model which ultimately helps in arriving at the fair value. So evaluating multiple factors is a challenge for auditor as well, because for some assumption he will have data, management will have a structured data to demonstrate that they have arrived at a particular assumption after evaluating multiple options. For certain assumptions, that data could not be available, and the auditor will have to apply his understanding of business professional judgment. Every fair valuation is subject to estimation uncertainties, which is the inherent risk associated fair value measurement, that the ultimate output could be different from the estimates or the current fair value estimation. Okay. While developing fair value estimate, management bias also comes into picture, intentionally or unintentionally, because when the management is using various input, okay, there could be a possibility that management tend to use the inputs which give them favorable input, favorable outcome. So as an auditor, questioning those biases or be aware of those biases, questioning decision taken on the basis of those biases is equally important. Then only as an auditor, we will be able to audit the fair valuations. So these are the challenges which auditor faces while auditing the fair value measurement. We'll take an example. Okay, in illustration 1 to 3, we discuss about various transaction where fair valuation could be used. Okay, which was related to a optionally convertible instrument issued by a startup, fair value of employee stock appreciation right, and fair valuation of investment in a subsidiary. Okay, let's assume the fair valuation is arrived on the basis of discounted cash flow model. In this case, as an auditor, let's see what are the various factors which we need to pay attention to. Okay, the first and foremost important, when there is a discounted cash flow model, we need to check how the free cash flows are arrived at. Okay, in free cash flow, there will be various elements like revenue growth. Okay, the order book projection. So the confirm order book will be available with the company, and on that basis, they will project future revenue. For an auditor to check the future projection is not so easy. He can either rely on a historical financial information, apply his understanding of business to a certain extent, and challenge the order book. But it is very difficult to get 100% comfort over the projection. Management could factor in various transactions. Let's say in case of a startup which is heavily dependent of the subscribers. Okay, today Zomato, Swiggy, Paytm, okay, their valuation is dependent on the number of prospective subscribers. Number of prospective subscriber is again dependent on how heavily they spend on acquiring new customers. Now arriving at this number is not an easy task. Okay, you will have the number of visitors to your website or your application, number of downloads to the application, but from those views or those visitors, how many visitors are converted into actual users for a particular company is very subjective. Similarly, there could be potential new business opportunity which are factored in the valuation by the management. When management is considering revenue, when management is considering growth in revenue, or considering various expenses in proportion to revenue, the management will consider new business opportunities, which will either give rise to increase in revenue, new streams of revenue, or decrease in cost, or most effective utilization of the cost incurred, which again will help in generating better cash flow. There could be expected capital expenditure and the profitability based on the future projection is also an important thing. In cash flow projection or discounted cash flow model, the terminal growth rate is also important. There are various methodologies related to arriving at a terminal growth rate as well as terminal value. Ultimately, in a discounted cash flow model, this terminal value also affects the fair valuation. Discount rate. Discount rate is generally considered as a weighted average cost of capital. So the company will plot future free cash flows, discount it at a particular rate, and that rate is dependent on weighted average cost of capital. Computation of weighted average cost of capital is based on the debt equity ratio, cost of equity, cost of debt. Auditing this estimate is significantly different from the auditing a normal transaction, a normal voucher where expense is verified on the basis of voucher if it is tallying with the books of accounts, and if there are proper supporting for the authorization, auditor may rely on that transaction. But now in this case, whether it's a cash flow, terminal growth rate, discount rate, auditor needs to apply his professional judgment and perform additional procedure to get comfort. One more important thing is liquidity discount. Whenever valuation of any instrument, that instrument is not readily tradable in market. And in fair value definition, we have noted a point that market participants' expectation is very important. So it is not only about the value of the business, the ability to sell that instrument or sell that business is also important. So this liquidity discount plays a very important part. So from auditor's perspective, let's say we discuss 3 transactions. Okay, accounting, we could agree with the management and ensure that it is appropriately recorded as per Ind AS. But now see the procedure which we need to perform on the valuations which are provided by the management. The efforts which we need to put in testing these assumptions are significant than the normal audit testing of any transaction, like normal manufacturing sale, normal operating expenses. So that's why the auditing of fair valuation or fair valuation measurement assumption is very critical for an auditor. With this, we will move to the requirement and guidance as per standards on auditing. Okay. When we discuss about SA 540, SA 540 basically deals with the auditing estimates and the fair value estimates and disclosures. Okay. In SA 540, when it defines the estimate, various aspects related to fair valuation, it gives guidance which is based on the other standards on auditing, which we are going to cover in next few slides. So what are these requirements or what are the auditing standards which are important when auditing a fair value measurement? Okay. SA 315, which is related to identifying and assessing risk of material misstatement through understanding the entity and its environment. It is very important auditing standard when it comes to auditing the fair valuation assumption. We were discussing about an example where an entity is following accounting policy of fair valuing its investment through other comprehensive income. At each reporting date, the entity is fair valuing the investment. The balance could be material for the entire financial statement, and considering the nature of entity, okay, where the fair value of investment is paid attention to by various stakeholders, we need to understand whether the fair value assumption could give rise to a material misstatement in the financial statement. Okay, once we assess it, the second important essay is essay 330, where the auditor's response to assess risk is explained. Once we identify a risk of material misstatement related to a fair valuation assumption, it is very important to develop a mitigating plan in response to the assessed risk. While auditing fair value assumption, we may come across certain valuation where we believe that as an auditor, we lack certain skill and we may need to rely on expert, which is engaged by us. That's why we will also have to pay attention to SA 620, which is related to using the work of an auditor's expert. And considering complexity of various transactions, nowadays, it is equally important that auditors should think about involving internal experts. Once we evaluate the valuation, fair valuation models, fair valuation measurement, ensuring that we have the appropriate evidence on our records to conclude about the fair valuation measurement is equally important. And it is covered under SA 500, Evaluation of Audit Evidences. In the audit of fair valuation measurement, the management representation will play a very important role. We discussed few things related to future cash flows, okay, future turnover, basis of considering turnover or basis of considering various growth rates. In that case, we will have to rely on management representation on certain aspects, because the considerations which are considered by the management in the valuation are related to certain future plans. And for that, written representation from management is important. In case of high risk fair valuation estimate, communication with those charged with governance is also important. And all these requirements are factored in SA 540. We will start discussing requirement of various essays, and what we can do. We have one example related to fair valuation of investment and investment in a subsidiary. We can take it as a base example and discuss the auditor's responsibility related to particular essay with respect to that example, so that it will be easy to understand. I will just touch upon certain requirement of SA 315, which is related to identifying and assessing risk of material misstatement through understanding the entity and its environment. As an auditor, we should obtain the understanding of the following items, okay, to assess whether there is a risk of material misstatement for the accounting estimate. In this case, it is a fair valuation estimate. Okay. So what we need to understand? We need to understand what is the applicable financial reporting framework. At the time of understanding the fair value definition, okay, or the requirement for fair value, we mentioned that there could be various financial reporting framework, and the definition of fair value could be different under different financial reporting framework. So understanding that definition based on the financial reporting framework or in the context of the financial reporting framework is very important for an auditor. How management identifies those transaction events and conditions that may give rise to the need for accounting estimate to be recognized and disclosed in the financial statement is also important. And this we can do by making inquiries with the management. So as per SA 315, it is important to understand or to obtain the understanding of the financial reporting framework associated with the fair value measurement. Second, how management identifies those transaction events and condition is also important. So when we were discussing that it is important to obtain understanding how management identifies certain transaction, okay, what does it mean in the context of fair value measurement and disclosure? Okay, we will see. Okay, when we are discussing about the management process, okay, we should understand how management is assessing the fair value measurement. Okay, so the process of identifying the fair value measurement, then the controls implemented by the management in the fair valuation process. Let's say there is a fair valuation requirement for investment in subsidiary. So this is based on the Ind AS, which is a financial reporting framework. So on the basis of financial reporting framework, at each balance sheet date, management will carry out the fair valuation. Okay, this is a mandatory requirement. Management should set a process for fair valuation. So what this process will comprise of? Okay, it will comprise of identifying the investment which are required to be fair value, basis of fair valuing those investment, so which valuation methodology approach the management should follow, identifying various assumptions which could be used in the fair valuation. Okay, now how to select those assumptions, how to validate those assumptions as a management is also a process which management needs to implement. Management needs to ensure that there are proper control. Okay, let's say there is a fair valuation related to employee stock appreciation, right? The people who are forming the scheme should not be responsible for forming or computing the fair valuation as well, because then there is no maker checker control or there are vested interest. So the people or the employees or the person who is developing the fair value estimate, who is responsible for the entire process, should be someone who is not involved in the activity of or taking decision related to fair value. When we say the expertise people who are involved in developing the fair value measurement estimates, it is important to consider their experience and expertise. It could be in-house team, it could be external consultant engaged by the management. In case of external consultant, whether he has the qualification, whether he has the requisite experience, whether he has the objectivity and independence to carry out the job is very important. Similarly, when it comes to employees, okay, though those are employees are in-house employees, it is important to understand whether they have requisite knowledge, experience, qualification to carry out the valuation or the fair valuation. In understanding process related to management assumption, it is also important to understand what types of assumption management is going to use in the process, because ultimately the fair value is a mathematical number which is based on the assumptions. It is a function of various assumptions. Understanding role of information technology is also important when we are developing the management is developing the fair value assumption, and as an auditor we are testing those assumptions. If management is heavily relying on the information obtained from the IT system, information which is extracted and processed from the IT system, then as an auditor we need to understand what are the control, what are the various checks which management has implemented to ensure that the information is appropriately extracted and it is relevant for the underlying fair valuation. As an auditor, it is important to understand which accounts or transaction are impacted by the fair valuation. There could be certain accounts or certain transactions which are very routine, okay, like fair value of mutual funds. Okay, it's a routine transaction. Current investment account is impacted. So if auditor understand this, then the focus on this area or the procedures related to this area could be significantly different from the other fair valuation assumptions. Using the work of service organization is also an important thing when we are evaluating entities' processes. Okay, it is important in case of a payroll. Okay, let's say entire payroll function is outsourced by the entity and we are evaluating certain data which is provided by the service organization. So service organization is someone who is transacting on behalf of the company. So they are keeping they are processing the information on the basis of inputs received from the company, and they are providing output. Now, on the basis of output received from a service organization, if management is developing certain estimate, then as an auditor, we need to understand how this process works. What is the role of the service organization? What are the controls implemented by the management to ensure that appropriate data is sent to the service organization and the output received from them is reviewed. Also, it is equally important to understand whether the service organization has appropriate controls which will ensure the data processing is appropriate. Management uses various assumptions in developing a fair valuation measure, or in arriving at a fair valuation. Documentation supporting management assumption is important. Let's say in case of actuarial valuation, management is considering 9% salary growth rate. Okay, if this rate is not supported by the documentation, which could involve historical salary growth rate, trend in the industry, what are management's plan for the future? If it is not documented and it is just a number considered based on the management estimate for the future payout, then it will not work. Management will have to justify the supporting document using the assumption. The process, okay, which is followed by the management to develop and monitor the assumption is important, because identifying fair valuation requirement is one thing, developing or identifying assumption is another thing, and then continuously monitoring those assumptions is equally important for the changes in the external environment, changes due to business strategy, which could have impact on those assumptions. Okay, so management should have a process, and as an auditor, if we cover these aspects in our inquiries, we will be in a better position to assess the risk associated with the fair valuation. In case of fair valuation, various types of base data are used. Okay, so in case of valuation of a company, base data could be the projection, financial projection, which are used. In case of let's say valuation, fair value of a defined benefit obligation, okay, employee related information is a base data on the basis of which the defined benefit obligation is computed, along with considering the policies of the company. Therefore, consistency of the data, the timeliness and reliability of data is also equally important. So as per SA 315 and SA 540, it is important that auditor understand the process followed by the management on the basis of these various parameters, so that he will be in a position to assess the risk of material misstatement related to fair value measurement. We will discuss an example which is related to a holdco. Okay, I would request you to go through this example. I will read it out for you, but independently you can also go through the example. The holdco limited has invested in equity shares of subsidiaries which are engaged in infrastructure projects, and elected an irrevocable option to fair value investment in subsidiary through other comprehensive income as per Ind AS 109. Management has carried out fair valuation of investment in equity shares of subsidiaries at reporting date. Okay, this information we have on the basis of preliminary discussion with the management. Now we also know on the basis of draft financial that the fair value of investment is 1000 crore. Net worth of the holding company, okay, I'm only referring to share capital and free reserve, is 800 crore. And the fair value through other comprehensive reserve is 750 crore. So there is a significant impact of the fair valuation on the asset side as well as on the reserves. The difference between the fair value of investment and the reserve is mainly because of capital gain tax, because fair valuation entries are recorded net of tax. So even the tax amount, if we roughly compute it to 250 crore, is very significant for a company which is having revenue of 2000 crore and profit after tax for the year of 150 crore. Okay. So in such a scenario, any change in assumption, any bias in assumption, any error in developing an assumption could have material impact on the balance sheet, because the valuation of investment is 1000 crore, as well as other comprehensive income, tax liability, and the fair value reserves of the company. So if this fair valuation is having a significant impact, then as an auditor, we have to consider the estimates used in fair valuation for the risk of material misstatement. Okay, there could be management override control also in the estimation process. So as an auditor, we will have to consider the factors given under SA 315 and identify it as a risk of material misstatement. Once the auditor identify the fair valuation assumption as a risk of material misstatement, another auditing standard comes into picture, which is SA 330. SA 330 deals with the auditor's responsibility when responding to assess risk. So once auditor decides that there is a risk of material misstatement related to assumptions used in the fair valuation, auditor needs to consider whether management has appropriately applied the requirements of applicable financial reporting framework. So in our earlier example, where investment in a subsidiary is fair value through other comprehensive income, the applicable financial reporting framework is Ind AS. Okay, let's say the accounting is as per Ind AS. Now, the other requirement of Ind AS is fair value, and fair value is defined under Ind AS 1130. Now, as an auditor, we need to validate whether the fair valuation is computed as per the requirement of relevant Ind AS. Second important thing, which is very crucial, is whether the method for making the accounting estimate is appropriate. Okay, the method used by the management in making the accounting estimate, in our case, it is a fair value of investment. So method used by management for fair valuation of investment is appropriate or not, and whether it is consistently applied over the period of time. So we will see how this second part, okay, method for making the accounting estimate appropriate is decided by the auditor. Okay. Yes. So when auditor is assessing the risk of material misstatement, the auditor should test the entity's fair value measurement and disclosure and consider whether the events up to the date of auditor's report are appropriately addressed in developing the fair value estimate. Second, test check data used by the management in making the fair value estimate. Once we ensure that appropriate financial reporting framework is applied, now our focus is on testing the fair valuation. So first, test check the data, evaluate the method which is used by the management. Also, the reasonableness of assumption used by management is very important. And when we are discussing about reasonableness of the assumption, there are various assumptions related to discount rate used in calculating present value of cash flow. In discount rate also, there could be two factors: cost of debt, cost of equity. So as an auditor, we need to consider the general economic factor which are prevalent in the industry. Any industry or entity specific factor which is relevant for developing that expectation. I'll give a small example. Suppose there is an entity which is operating in a segment where banks or the financial institutions are not willing to lend that easily. In that case, if economic environment is uncertain, the cost of debt should be relatively high. That should be the expectation of auditor, and management should factor it in their development of assumption. As an auditor, we should also consider this fact while evaluating the assumptions used by the management. Similarly, suppose there are certain transactions happening in the industry, okay, and where the cost of debt or the cost of equity considered is relatively high, then as an auditor, we should check, or we should be aware of such transactions so that we can challenge management when management is using those assumptions. We should also consider the plans of the entity, because management plans are approved by the board of director or the expert management committee. If such plans are approved, validated by them, those are charged with governance, so we can consider those plans in our evaluation as well. We can also check the assumption used in prior period and what is the actual result as compared to those assumptions. We will discuss the requirement of SA 330 with the same example, which was related to fair valuation of investment in subsidiary. Okay. As an auditor, we have considered it as a risk of material misstatement. Now, what is the approach which auditor should follow? You can think about the approach for 2-3 minutes and jot down your points, and we see which approach we should follow. Just consider requirement of SA 315, SA 330 while deciding the approach which auditor should follow. And that approach is, I will simplify that. It says, identify the financial reporting framework, understand the process implemented by the management to identify the fair valuation requirement, to develop the assumptions used in the fair valuation, to extract the data related to fair valuation, controls implemented by the management, involvement of expert, review of base data which management is using. So everything should be considered by the auditor in auditing the fair value measurement. So we will discuss the approach on this slide. Just wanted to clarify a thing. Many a times we rely heavily on the valuation reports provided by the management, if those valuation reports are from a reputed firm. And we consider them as it is for our audit documentation by just tallying the number which is appearing in valuation report with the financial statements. But that is not what is expected in standards on auditing. As per 315 and 330 and 540, the auditor's responsibilities are clearly defined. So when we are planning our work, we need to focus on following things. Okay. So when we were discussing about the fair valuation of investment, as an auditor, first thing we will do, we will understand the process implemented by the management to arrive at the fair valuation of investment. So what does it mean? What does it mean by the process? The process for identification of fair value estimate. Okay, so first we have to fair value an investment. How will be fair value investment? Investment will be fair value based on the discounted cash flow model. Discounted cash flow model will have future cash flows discounted at a weighted average cost of capital. As an auditor, we need to understand the process of identification of estimates, okay, which are used in the fair valuation, which could be discount rate, cash flow, growth rate, terminal growth rate, etc. Okay. Process for identification of financial reporting framework. In our example, it is IND AS. Process for identification of significant assumption, which are used by the management in arriving at the fair value of investment. After understanding the process implemented by the management, which we need to document as well as an auditor, we need to understand the segregation of duties and experience of person involved in developing the estimate. So as an auditor, we will have a document where we will document our understanding about the process followed by the management to arrive at the fair value of investment. Second, we will also document our understanding related to segregation of duties and experience of persons involved in developing those estimates. Okay. When we are saying segregation of duties, we can refer to the prepare, reviewer, control. Experience and expertise of a person involved in developing models could be related to their educational qualification, their industry experience, their experience with the working on the specific fair value measurement. Those things we can consider on the basis of inquiries and document it in our work papers. If management is involving an expert, so for fair valuation, let's say they are involving an external consultant, we need to evaluate competence, objectivity, and independence of the management's expert involved in the process. If fair valuation is of investment in subsidiary and the subsidiaries are in infrastructure sector, let's say the expert has never done any valuation related to infrastructure entity, then we have to be extra cautious while relying on his report. Similarly, the objectivity and independence of expert is equally important. If he is not objective or independent of the management, then we have to be very cautious when we are relying on his report, because then the possibility of management bias in the evaluation is significantly high. So once we understand the process, once we understand the expertise and experience of the personnel involved in the valuation, as well as the expert, if any, involved by the management, the next steps start. Okay, we will get the information, we will get the valuation report. Okay, now what? We need to check the base data which is used in the fair valuation. Okay, so how we will check that? Suppose there is estimated revenue. For estimated revenue, we can verify the historical experience. If we are auditor for number of years, we can see the trend in the revenue, what is the increase over the period of, let's say, 5 years, 10 years, and whether they appropriately factored by the management in the future projection. If projected growth rate is significant past experience, then auditor should challenge it. Auditor should discuss with the management what is the basis of considering projected growth rate, which historical experience, or sometimes the information related to peers in the industry is available. Suppose there is a listed entity, or suppose there is a industry related report which is available in public domain, where the historical growth in revenues are published. Information related to historical growth rates are published. We can cross check the growth rates used by the management with such reports after performing due diligence on such reports, or relative due diligence, before directly relying on them, and verifying whether the growth rate seems appropriate. Also the basis, okay, in case of certain industry, there could be confirmed customer contract for next 2-3 years. There could be government biddings. There could be new business development because of which there are the increased revenue projections. Okay, then we need to discuss it with the management, evaluate it appropriately based on the available information. Management should have supporting document to consider such assumption or consider such revenue estimate, which auditor needs to rely, validate, and conclude that those are reasonable. Okay, in case of estimated cash flow projection, so in case of a valuation model, revenue is important, but ultimately cash generation is important, because your management is discounting free cash flows. So how they arrive at a free cash flow? Generally, in case of most of the industries, it will be EBITDA, earning before interest, depreciation, and taxes, okay, which is operating cash flow. So we can check historical percentage of EBITDA, compare it with the industry, compare with the business developments and projected expenses. Also, we can consider the inflation factor, which could be there and which could affect the cost, and then evaluate whether the EBITDA or the operational cash flow considered by the management are appropriate or not. Two important things which could be there in any fair valuation is repayment of debt and finance cost. Okay. In a discounted cash flow model, when you are reviewing as an auditor, suppose if we change the expected cash flow of debt repayment or cash flows for interest cost, there could be significant impact on the discounted value, because as cash flows are delayed, the value increases. If cash outflows are in initial period, then there could be negative impact on the valuation. So what assumption management using, whether those assumptions related to financing are based on the existing debt agreement, repayment schedules agreed with the management, or those are based on the expected future financing arrangement, is very important. Similarly, when management is considering higher revenue projection, to drive that growth, the management will also have to invest in capital expenditure. So while checking the cash flows, it is important to check whether management is considering the outflow on capital expenditure also when they are projecting the estimated revenue, or they are considering the better utilization of capacity. So these are the procedure which we will perform on base data. Then the testing of reasonableness of cost of equity, cost of debt, considering current market scenario, industry specific factor, and entity specific consideration is also important. As an auditor, it is also important to evaluate whether these assumptions are tested for sensitivity. If there is a sensitivity testing, let's say we change a particular assumption by 0.5% or particular revenue stream by 50-60 crore, what is the impact on the financial statement? This stress test of sensitivity really helps auditor to understand how a particular assumption used in the valuation, fair valuation, impacts the outcome, and how he should plan his procedure to get comfort on a factor which is impacting the valuation in most significant manner. There is a small discussion related to cost of debt and cost of equity. We are reviewing the valuation report of Holdco Limited and noted that the average borrowing cost is 9%. While considering the fair value, the same cost is considered by the management. Though recently there is interest rate increase by the central bank. So if there is interest rate increase, as an auditor, we need to evaluate its impact on the company as well. If interest rates are increasing for all the sectors, obviously it will have impact on the average borrowing rate of the company, and accordingly the management should consider the increased borrowing rate and not the earlier borrowing rate in future cash flows. A change in borrowing rate, let's say by 0.5%, could have a significant impact on a company where debt equity ratio is considerable. Okay, in case of, let's say, infrastructure company or a special purpose vehicle, which are financing project based on debt. Okay, their change in interest rate could have significant impact. Similarly, in case of cost of equity, let's say Holdco is considering 15% as cost of equity in past, but recently due to Ukraine-Russia war and other global economical factors, there is liquidity crunch. Therefore, it is not easy to get equity. So if assessing, or if equity is not freely or not easily available, the cost of equity should go up, because the person who is putting money in any business would expect higher return from that business in case of uncertainties. So the cost of equity should undergo a change. So as an auditor, challenging the assumption based on the current economical factor, geographical factors, as well as uncertainties is very critical. With this, we covered requirement of SA 315 and SA 330. And now we will move to requirements of other essays. The first essay which is relevant in this discussion is the using the work of an auditor's expert. Based on the nature of engagement, the auditor should consider whether an expert is required to be involved. And there could be cases where auditors' knowledge related to development of a fair valuation measurement could be limited, and he would require someone who could assist him in evaluating the basis or evaluating the workings report provided by the management. In such case, SA permits the auditor to rely on his internal expert. While planning the work or while planning the use of expert, it is important the auditor consider whether expert understand the definition of fair value and the method that the management has used. It is very important because sometimes the expert may not be a chartered accountant. In such a scenario, he should be aware what is the financial reporting framework, what is the fair value definition which auditor is looking at, so that he can decide the approach of testing the valuation model valuation report provided by the management. Ultimately, it is auditor's responsibility to assess the results of the procedure performed by the expert. So when we are concluding in our audit report, whether we are relying on management expert or auditor's expert, we have to ensure that management expert is objective, independent, and competent to perform the job. In case of auditor's expert, obviously we will ensure that he is competent, objective, independent. At the same time, he is aware of the exact requirement of financial reporting framework, exact objective of the auditor. Then only he will be able to help the auditor in best possible manner. Next essay which is important is the evaluation of audit evidence. As an auditor, it is our responsibility to opine on the true and fairness of the financial statement, and for that we evaluate the audit appropriateness of the audit evidence, sufficiency as well as appropriateness of the audit evidence. When we are evaluating fair valuation, we should obtain the audit evidences related to management estimate, various assumption used by the management, various assumption related information such as revenue growth, terminal growth, discount rate, equity, cost of equity, cost of debt, etc. Ensure that those audit evidence are sufficient and appropriate to conclude that fair valuation measurement are appropriate and give true and fair and does not affect the true and fair view of the financial statement. Also, it is equally important to focus on the disclosure requirement. Up till now, we were focusing on the amounts related to fair valuation, its audit. Now the disclosure, if there is a specific disclosure requirement under the financial reporting framework, then auditor should ensure that he is aware of that disclosure requirement. He has obtained sufficient and appropriate audit evidence to ensure that the management has appropriately considered those requirements in the financial statement disclosure. SA 560, which is related to reviewing subsequent events, is also important. Suppose fair valuation is carried out at a balance sheet date, and before signing the audit report, auditor gets to know that the investment is sold by the company. Now, if the investment is sold and the fair value is significantly different from the purchase consideration or the consideration which is received by the company, then auditor needs to reevaluate the fair value used by the management, assuming that there is no change in other factor as compared to balance sheet date. If there is any change in circumstance or other factors in balance sheet after balance sheet date, which is resulting in change in fair value, then such change need not be considered. Let's say prices of actively traded marketable securities, okay, are changing after balance sheet date. So due to demand and supply, there is change in NAV of mutual fund. Okay, because NAV of mutual fund is again dependent on underlying value of instruments. If the value of those instruments changes because of demand and supply of the market participant, then the NAV will change. So auditor need not consider it. He should only focus on the value or the fair value which is at the balance sheet date. But suppose there is an unquoted instrument, there is no significant change as compared to balance sheet date, and the fair value which was considered in balance sheet was high, but actually investment was sold at a lower price, then the auditor can consider the lower price also as a fair value, because there is no change from the reporting date. Okay, which is highlighted again in point number 3 when we are using a subsequent event or a transaction to substantiate a fair value measurement. The auditor consider only those events or transactions that reflect circumstances existing at the balance sheet date and not new development post balance sheet date. Okay, after performing the risk mitigation procedure, relying on the internal expert, performing subsequent procedure, important thing is to obtain the written representation. SA 580 deals with the written representation, and it states that auditor should obtain representation from the management regarding the reasonableness and appropriateness of significant assumption. It is a primary responsibility of management to carry out the fair valuation. So as an auditor, we should take a representation from the management. Second, depending on the nature of fair valuation, materiality, complexity of fair values, auditor may consider taking the representation regarding appropriateness of measurement method. So the method used in fair valuation, whether it is appropriate in the context of the transaction, context of the instrument, or requirement of the financial reporting framework. Okay. Completeness and adequacy of disclosure, completeness and adequacy of data used in the development of fair value measurement, as well as an important management representation which could be taken is there are no subsequent changes or no subsequent event which could affect the assumption made by the management. Why it is important? Because there could be certain transactions which auditor may not be aware, but management is aware. And those transactions can have impact on the assumptions used at the balance sheet date. If that is the case, then auditor is not in a position to to verify such information. Hence, the management's representation is very important, because once it is signed by the management, they cannot say that the certain information was available with them, but it was withheld. After performing procedure, after taking management representation, what is the responsibility of auditor? I think now auditor is good to issue the audit report. But there is one more important, is the communication with those charged with the governance. Why it is important? Auditor is supposed to communicate critical matters which he come across during the process of audit, as well as his assessment of significant risk, procedure planned by him related to risk of material misstatement with those charged with governance. Certain accounting estimates are very sensitive, such as fair value estimate, because their significance to financial statement is very high. And the estimates could undergo change in future because of many events. So in this case, it is very important for the auditor to inform those charged with the governance the assumptions used by the management, what is the framework used by the management, what are the procedure which an auditor has performed, and what is the conclusion reached on the basis of representation, data used by the management, and procedure performed by the auditor. So auditor considers communicate in our example when we were discussing about the fair valuation of investment in a subsidiary, auditor may consider communicating the nature of significant assumption used in the fair valuation of investment in subsidiary, the degree of subjectivity involved in development of those assumptions, and the relative materiality of the items being fair valued to the overall financial statement. Okay, so who are those charged with the government? Those could be board of directors, audit committee, or any financial review board which is constituted by the board of directors. Also, in case of listed companies, it is mandatory, and for other companies, auditor may voluntarily decide to communicate key audit matter. If fair valuation estimates are considered as a significant estimate having high estimation uncertainty which could impact the financial statement materially, then it could be a key audit matter. Okay, so if you see audit opinions of certain listed companies who are having multiple subsidiaries, okay, the valuation of investment is always considered as key audit matter. The procedure performed by the auditor to address the risk associated with the fair valuation of investment are documented in key audit matters and communicated to those charged with governance. Okay. Also, there could be a situation where the assumption or estimate used by the management or auditor are significantly different. So we discuss an example where the cost of debt, which was considered by management, was without factoring the current economical factors. But auditor is considering it. Management is not ready to revisit their assumption. In case there is a judgmental difference in the fair value, if the value computed by management and value computed by the auditor are significantly different, and if that difference is having impact material to the financial statement, that is, it is above the materiality threshold set by the auditor should consider whether he needs to modify his audit opinion. If he is modifying his audit opinion, then he should communicate it to those charged with governance. So these are the responsibility of auditor under SA 260 when it comes to communication with those charged with governance. After discussing the guidance and the requirement of standards on auditing, let's discuss about the documentation requirement, which is critical nowadays because when the external regulators review audit work papers, audit file, they go by the standards or auditing. What are the requirements mentioned in the standards or auditing, and whether the work papers of the auditor are able to justify the work performed by him in compliance with those standards. Keeping a signed copy of valuation report in audit file will not help in such circumstances. Auditor will have to substantiate the work performed as per auditing standard. So we will see what are the key considerations which auditor should focus on while documenting the work performed by him on the fair valuation. Okay. Auditor should have a documentation of his understanding of the nature of entity, industry, and economic environment in his work paper files. Understanding the nature of fair valuation, applicable reporting framework, process implemented by the management to develop the estimates for fair valuation. So in case of, let's say, investment in equity shares of a subsidiary, applicable reporting framework is Ind AS, fair valuation estimates are cash flow, discount rate, terminal growth rate, etc. Process implemented by the management, who collects the data related to cash flow, how it is validated by the management, who collects the data related to discount rate, how it is validated with external factors, who assesses the terminal value. Okay, what are the controls over maker checker controls over the working prepared by the employees. Okay, all these factors are documented as understanding the nature of fair value estimate. Based on the understanding, the auditor should document his opinion or his conclusion regarding risk of material misstatement related to fair valuation estimate. If he considers risk of material misstatement associated with any fair valuation estimate, then he should perform testing of controls implemented by the management for fair valuation measurement and disclosure as well, to ensure that controls are effective. Second, he should plan the substantive procedure to mitigate the risk of material misstatement for fair valuation. So when we are saying substantive procedure, it will involve testing of base data, testing of assumption, validation of assumption, etc. Then auditor should document the testing of information provided by the entity. What is the meaning of information provided by the entity in case of developing a valuation, fair valuation measurement? Suppose management is heavily reliant on a report extracted from IT or a report prepared in Excel or prepared in any software, then auditor should understand how it is prepared. When the data is extracted, the file is compiled, whether the data is complete, whether there is possibility of any modification, whether there are appropriate control to ensure the reliability of data. Also, in case of fair valuation, if auditor is relying on management expert, then he should clearly document how he evaluated the independence, objectivity, and competence of the management expert. This can be done with inquiries with the expert, obtaining information from external sources related to competence of the expert, prior experience with the expert on the same audit client or any other audit client. Auditor needs to document clearly procedure performed. So what procedure he has performed. Let's say in case of a discount rate, which involves cost of debt and cost of equity, how he has validated cost of debt and cost of equity, how he has ensured that it is reasonable considering the nature of entity, needs to be documented. It could be a simple thing that cost of debt is a weighted average borrowing cost. So he will check the current borrowing rates, take a weighted average of that borrowing rate, compare whether in industry due to certain factors there is a possibility of increase in rate, whether there are certain factors which could result in potential future increase, and conclude that the rate used by the management is appropriate. But this needs to be documented in a work paper file. Sensitivity assessment of key input is also recommended, because when we are performing sensitivity analysis, or management is performing and we are reviewing, we come to know which factors affect the fair valuation in most significant manner. And then as an auditor, we can focus our procedure documentation over those factors. Review of disclosure, financial related disclosure, which are based, fair value related disclosure in the financial statement, which are coming from the financial reporting framework, are need to be appropriately reviewed by the auditor and ensure that those are as per the requirement of the financial reporting framework. We should have a management representation on our file, and it should cover the points which are critical for the fair valuation estimate. In case if there is a communication with those charged with governance, which should be there in case of a significant or risk of material misstatement identified related to significant assumption for fair valuation, it should be documented. So discussion with the board of directors should be documented. If there is a meeting, there should be minutes of the meeting. It should be either minuted by the company in their records or by the auditor and validated by the client. So if this document as a part of audit work papers, the auditor will be in a position to demonstrate that he has applied the requirements of auditing standard and appropriately commented on the true and fair view of the financial statement. So this is from my side. I would like to thank you for your patient hearing. If there are any questions, I would like to answer those questions.
So can you hear me?
Yes, I can hear you.
Yes, sir. Thank you so much for wonderful deliberation, sir. It was really very good and energetic deliberation. I have received certain questions. If you permit, can I ask those questions?
Yes, sure.
Yes. So first question is this relating to the normal credit term for trade receivable is 60 days. However, post balance sheet date, a fresh agreement has been reached with the customer that total outstanding as on March 2022 will be repaid in 48 installments. Then isn't this the case necessary to account the trade receivable as per India's 113 by discounting the total receivable as on March 2022?
Okay. So this question is basically related to revenue which is already recognized.
Yes, 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 yes.
So at the time of revenue recognition, if the agreement was valid and the credit terms were agreed, then the revenue which is recognized at a point of time should be based on the earlier agreement. While evaluating the recoverability of receivable, the auditor should pay attention to the new agreement. But in new agreement, as I understand, the credit cash flow is deferred, so it is not affecting the revenue recognition. I think
Yes.
so it should not affect the fair value of receivable.
Sir, there is one more query, detailed query relating to India's only. It is pertaining to dealing with the impairment, restrict use of the projected cash flow to 5 years, and exclude specifically the improvement in the future for estimating the fair value as per para 33.
Yes.
In case of infrastructure assets having long and committed development and operation period, this restriction is position problem in making auditors accept future cash flows. Also, as per this standard, discount rate is weighted average of the debt and equity. However, the project financing profile will not be uniform debt equity over the life, and hence the equity valuation is generally arrived at instead of asset valuation as per the debt equity ratio.
Yes.
And it debt equity ratio changes constantly over life, and hence one's value will not suffice. Then auditors have reservation is accepting equity valuation in view of India 36. So any expert opinion in this?
Yes, it's a very common concern
Yes.
Related to projection as well as the proportion of debt equity, because generally management tend to select the debt equity ratio which is as on date of balance sheet, but for valuation purpose I think the debt equity ratio which is maintainable over the period of project is important. So it could be 40-60, 50-50 based on the equity debt proportion at each balance sheet date. Okay, so the debt equity ratio which is required to be considered is over a period of time. The question which is raised is whether there should be a FCFF or FCFE valuation. That is very case specific and it depends on the nature of asset being valued and whether there could be a possibility of significant in case of constructed asset, whether there could be a significant possibility of difference in FCFF and FCFE. FCFF is a value on the basis of free cash flow to the company or firm, and the FCFE is the value which is on the basis of free cash flow to the equity. For constructed project, I think there should not be significant difference, and hence the valuation could be appropriately considered. Sorry, if I miss any part of that question, please let me know. The debt equity ratio I have answered.
Yes, yes, yes.
Value of asset versus value of business, that also I think I have answered briefly, and it is case specific.
It is case specific. Yes, yes, yes. So how to determine fair value and account for zero coupon unsecured non-marketable and compulsory convertible debentures which are convertible at the time not later than 10 years, at the discretion of the company from the date of allotment and number of shares to be converted, and price per equity share shall be determined at the time of conversion.
I think this is a more India's accounting query than the fair
Yes,
valuation.
yes,
It is
yes,
related to how to account for an instrument.
yes, yes,
We can
yes,
discuss it offline.
yeah, yeah, I will forward it to you, and
Yeah, I
then
can answer that query.
yes, yes, yes. I will forward it to you. Then you will please answer, sir.
Yes.
And one more question is a general question. Can you give us the at the end the in a gist what precautions or what guidelines are to be taken by the auditor while making this fair value trap?
Okay. So, what consideration auditor should pay attention to while auditing fair valuation? Is
Yes,
that
yes,
yes? So, I'll summarize it. First of
yes,
all,
yes,
auditor needs to understand for what purpose the fair valuation is carried out, whether it is fair valuation of investment, fair valuation of a liability, fair valuation related to a particular payment, let's say share-based payment or a purchase consideration. Once we have the understanding, we need to understand what is the procedure management is following. The procedure which management follow will include how they extract data, how they form their estimates based on the available information, how they use this information in development of a valuation model. What are the controls which management has implemented, and as an auditor we are required to test those controls. Okay, those could be management review controls or transaction level control, which auditor will vary. There is a actuarial valuation of gratuity where defined benefit obligation is fair value, so to say. Now it includes gross salary growth rate as well as discount rate. While arriving at salary growth rate, management should consider last 5 to 10 years trend and not increment rate for a particular year. As an auditor, we need to document how we check the salary increase trend for last 5 years, whether similar companies in the same industry are having this similar approach. Because if one company is giving higher increment, obviously employee will leave other
yeah,
company and join it. So all these factors auditor needs to consider and document in their work paper when it comes to reasonableness. And last but not the least, the management representation related to the assumption, communication with those charged with governance, and the review of disclosures. So these are the critical factors which auditors should consider while implementing.
yes. Sir, as far as the fair value consideration is concerned and valuation is concerned, one member is asking, is there any other technical qualification is required other than a chartered accountant? Or other than any reviewer or technical qualification is required for such?
Yes. So there are certain valuations. Okay, let's say valuation of a real estate, valuation of certain type of instruments. Okay, complicated instrument like let's say optionally convertible preference share, debentures, etc. As a chartered accountant, you can learn about these things, and on the basis of experience, you can able to handle the valuation. But having said that, added qualifications are equally important. There are specific courses related to valuation of say, real estate, valuation of ESOP, valuations of share-based other share-based payments. For actually, obviously, there is a separate course. So those courses are available. If someone wants to develop expertise, then he should pursue those courses. But as a CA, I think the basis, okay, which is mathematical modeling or the assumptions which are that a CA can review based on his understanding of business as well as understanding of entity.
Yes. So thank you so much, sir. We come to an end. It was really wonderful to have your lecture over here. It was really knowledgeable and knowledgeable deliberation, and in a very lucid manner with lots of examples. On behalf of WSP of ICI, I extend my heartiest thanks towards you for sparing your valuable time and for enlightening all of us on the various activities on this fair value consideration. Thank you so much for our. Thank you so much. Thank you.
I would also like to thank all the members who have joined, because this is on the occasion of Raksha Bandhan, they will have their personal commitment. Still, those who have attended, I am really thankful to them. Thanks a lot.
Yes,
And thanks,
yes,
ICI, for giving me
approximately 1,000 chartered accountants are here, sir. Log in. Yes. Thank you so much. Thank you so much, participants also. Thank you so much.
Thank you.
Namaste.